we have India's first retail REIT, which is set to open today for subscription. This is Nexus Mall that we're talking about. Dalip Sehgal, who's the executive director and CEO of the company, joins in now. Mr. Sehgal, you have close to around 10 million square feet of leasable area with committed occupancies of 93.5% odd. Just wanted to understand what's the sort of yield that you make on the portfolio that you have. At what rate will your portfolio grow going forward?
Okay, great. Morning, and thanks for having me here. You asked a couple of questions. The first one is in terms of the portfolio itself. Let me just explain. We have 17 malls, 10 million square feet. More importantly, we have 3,000 stores, 1,000 brands, almost 130 million footfalls in a year, and we have in tenant sales more than $1 billion. So basically what we are saying is that while we are a REIT, this is not just a real estate play, it's more of a consumption story. I think that's the first thing that's very important.
So we understand that.
What will be, sorry?
No, we understand that it's a consumption story, and which is why we ask you for numbers based on what kind of growth can you foresee here, given the sort of growth in the consumption basket of India.
If you look at pre-COVID, we were growing at about 11-12% CAGR. India consumption grows at around 10-odd%. Last year, up to December, April to December, we grew at almost 30%, which obviously in some ways is not sustainable, meaning it's obviously 2 years of low sales and then huge growth last year. What we have in terms of guideline, what we have given is an 8.5% CAGR for the next 2 years. So our overall sense is that given our past record of about 10-11%, that's the kind of growth that we should be able to see as we go forward.
All right. Hi, Mr. Sehgal. Good morning. Thanks so much for coming on the show. As a percentage of your total assets, how much of that is towards the retail segment, if you could tell us that? And the second part is, what is the current occupancy?
Yeah, sure. Morning. And first of all, 95% of our assets are retail. So we are essentially a retail business. We have 2 hotels and we have some office spaces, but those basically, when we acquired, came with the mall. So we don't separately buy either hotel or offices. So 95% of our business is retail. We are focused entirely on retail. That's the point, first point. The second is in terms of occupancies. Our current occupancy is 96.2%. And as we go forward, I think this will go up to probably 97.
Right. And what's the sort of yield that you generate on the assets that you hold right now? I mean, I presume because it's retail, it would be about 1% or 2% higher than the office and commercial leasing?
That's right. Yeah, fair question. So I think what the REIT would, in terms of distribution yield, would be able to give is about 8.25% quarterly compounded in the first year. And if you take a 3-year period, probably around 9-odd%. In terms of post-tax return, because 65% of whatever is distributed is tax-free, the post-tax return could be between 7.2% for the first year itself. So that's the kind of yield. Compared to, let's say, a 10-year GSEC, this is about 100 basis points higher. And compared to most of the office REITs, which are given 6 to 7%, this would again be anywhere between 80 to 100 basis points higher.
Right, but last week we had the management of Blackstone, and they said that retail actually trades at around 8.5%. So you're saying post-tax would be close to around 7-odd%, 7.2, 7.3 odd percent. We'll take that point on board. The money that you raise.
Just to clarify, pre-tax is 8.25. So not very different from what they may have mentioned. So there's a pre-tax and there's a post-tax.
All right. And of the money that you're raising, I see close to around 1,400 crores coming in as fresh issue. What are your plans with regards to increasing the assets that you have with this money? And will you have to take some more debt to fund the asset expansion?
Fair question. I think the first thing is that whatever money is being raised is essentially being raised to repay promoter debt, sponsor debt. In terms of what is available for growth in the future for acquisitions, our LTV will be around 15.5% at the time of the listing, which means that most of the other REITs which are listed operated in LTV of around 27-28%, gives us a headroom of almost $500 million in terms of debt that's available. Number two, as you know, in a REIT situation, a mall owner can actually roll in with no tax incidence. They can convert their physical asset into a financial asset by converting it into REIT units, and those REIT units have no tax implications. So in terms of our ability to acquire more, we have a war chest in terms of how much debt we can take, and we also have the ability to issue units instead of. So if, let's say, a mall owner wants part cash and part units, that is possible. If they want full debt, that's possible. Just to give you the perspective, there are about 100 odd A-grade malls in this country, out of which the top 4 guys own about 45. So there are 55 assets, 30 million square feet, which is still available. And most of these are people who own 1 or 2 assets, and this may not be core for their business. So I think our ability to acquire in the future also is pretty strong.
And will we see your NOI margins expanding from here on?
I think we have, in the DOD, we have mentioned that we will have an NOI growth of 17% between the 2 years that we have projected, which is FY24 to FY26.
Okay, Mr. Sehgal, thanks so much for stopping by. Wishing you all the best, and we're looking forward to having a chat with you in the times to come. Thanks.